your collateral is your salary in 10 years. So you become a slave of that debt because if you don't pay, they will come for you.
Everyone should be there in Bitcoin Treasury, and they're like maybe a little bit controversial, but there shouldn't be Bitcoin Treasury company. Imagine instead of one MicroStrategy, there will be 100 of them holding 8,000 Bitcoin instead.
My favorite example is Elon Musk. When he was buying Twitter, didn't buy it for 40 billion in cash or whatever the price is. He actually used his Tesla shares as a collateral.
Bitcoin-backed loans, but it's kind of already paid if you don't want to pay it back. Nobody will come for you. Okay, happy to be here, and hi to the only Spanish guy who woke up early. Yeah, we like to party. So, Joe was speaking a lot about Bitcoin-backed loans, and the truth is that the topic of the panel is about how to maximize your stack. So first question, before, of course, we will be talking about loans, but first question I wanted to ask you is, what else can we do aside of hodling? Because this is what they teach me, buy stack sats, and you're good with that. But what else can a Bitcoiner do with his Bitcoin? Josh, for example.
Yeah, no, I mean, it's most obvious that we're here for Bitcoin-backed loans. So, opening a loan against your Bitcoin is actually, there's so many benefits to it. I mean, it's a risk approach that you're taking, but you're able to use your Bitcoin in a sort of secure manner without having to sell. So it's tax efficient, etc. I mean, but other than that, in the long term, of course, I hope that payments, etc., around this will become more sufficient. And like Bitcoin-backed credit cards, Bitcoin-backed mortgages, actually being able to utilize your holdings and be financially inclusive in the traditional system, that is the end goal. And Bitcoin-backed loans is a first step towards that direction.
Yeah, Paolo?
Yeah, I mean, there are several strategies that allow you to generate a yield on Bitcoins. Certain strategies are like carry a higher risk. I think seeing Bitcoin as a collateral that allow you to maximize your stack, access to liquidity, to from a tax perspective, avoid to pay taxes in case of a sell. That's, I think, the most interesting use case that I see to optimize your Bitcoin and generate a yield on it.
Okay, I have questions for that, but we will get into them later. Igor, what would you say?
Yeah, well, I mean, obviously, when you're asking a question about what else you can do with Bitcoin, I mean, there are Bitcoin yield products, right? If you're aware, but I would always say, like, do your own research in terms of what's actually happening with Bitcoin, right? So basically, the concept is that, hey, send us your Bitcoin, we're gonna give you 1, 2, 3% yield on your Bitcoin, right? So I would just kind of warn people to really do the research and try to understand what is actually happening, because normally under these circumstances your Bitcoin would be rehypothecated. That means it's usually sent to traders, hedge funds, other institutions. We're going to be talking, of course, about Bitcoin-backed lending, but if you hear about Bitcoin yield strategies, pay attention, take care, and really make sure that you understand what's going on.
Yeah, maybe to add on there, what you see a lot is you take a Bitcoin-backed loan to buy more Bitcoin, which is obviously leverage. And it's interesting dynamics, because if you then post that collateral the extra Bitcoin you've bought, you're reducing the loan to value. So you're sort of reducing the risk, but you have more exposure to Bitcoin. So there's quite some interesting dynamics you can build around that. But again, it's super high risk because you're already all into Bitcoin, and then you're even more all into Bitcoin.
Himanshu, thank you for joining us. I was asking, what else can you do with Bitcoin aside of just hodling it?
Well, you can do everything you want with it, right? Bitcoin is a reserve asset, and the way you use a reserve asset to enable your life is you make other investments with it. You use it to fund your lifestyle. If that's the case, we have clients who use Bitcoin for all kinds of use cases. I'll give you some fun ones, and then I'll give you some general use cases. So we funded a Hollywood movie. We funded a private racetrack, a yacht, a sailing business, tons of coffee shops all around the world. And those are obviously more interesting, exotic use cases. But I think in general, we see people more on the retail side use it to fund cash flow needs, use it to make investments in their businesses, often to buy more Bitcoin as well. And we also see people use it to buy other assets. In our opinion, Bitcoin is an asset that you save and you hold on to, and you keep adding to it. But everything else is in the world needs cash, right? So in order to activate your stack, you need cash against it. Bitcoin's CAGR typically outpaces the interest rate that you're paying with any of our lending companies. And as a result, it's always smart to borrow against an appreciating asset to spend a depreciating asset, which is cash.
Okay, you said something, you brought this CAGR topic that I love it because it's normally related with treasuries, no? And you only listen to it when the conversation is about treasuries. And I love it that you bring it because when I do lending, I practice lending for 3 years. I feel I am my own treasury. Uh, do you feel the same? Like you don't have to buy a treasury, you can be your own treasury and you can become your own sailor?
Everybody here with their own stack is their own Bitcoin treasury, right? What is a Bitcoin treasury? It's a company that lives on a Bitcoin standard, saves in, it has assets in Bitcoin instead of in cash, and it then uses that Bitcoin to beat the hurdle rate of Bitcoin, hence enabling the Bitcoin per share and beating Bitcoin's CAGR. And if you do that yourself, you're basically managing it for your own use cases. And hopefully, given how much you may have, everyone has different goals and everyone has different amounts of Bitcoin they hold, and they want to enable different things for their life. So you can have a more high risk approach. You can have a very stable, safe approach. Many people just want to hold Bitcoin and not do too much with it. We enable that for our clients in many different ways. We have very vanilla, simple over collateralized loans. We have stuff for people who are retired and they just want tax-free income every year. We have stuff for people that don't have an active income and they use that as well. On the other side, maybe you have a very high income, and in the US, there's this thing called tax depreciation where you can depreciate your taxes by investing in certain assets such as Bitcoin mining operations. We enable that as well, and we also have people that are more on the institutional side, like Bitcoin treasury companies, who do things like caller loans where there's no liquidation risk. So it really depends on what your use case is and how you want to enable it. I think there's very low risk, low effort ways to do it, and there's some which are more involved, and you can really pick and choose.
Ironically, you're saying like, yeah, you're basically your own treasury company. But looking at where we come from in the Bitcoin space, I mean, everyone should be their own Bitcoin treasury, and they're like maybe a little bit controversial, but there shouldn't be Bitcoin treasury companies, right? If you're adhering to the be your own bank principles, I mean, ideally, like you would apply the same strategies. Don't get me wrong. Like if you want to be a certain risk profile, sure, go ahead. But I hope in the long term that everything is super decentralized and everyone is applying their own Bitcoin treasury strategy, and that will be a lot healthier in the market. Imagine instead of one strategy, MicroStrategy, there will be 100 of them holding 8,000 Bitcoin instead. That will be a lot better for the market. Also for the risk of Bitcoin-backed loans and all the other products. I mean, we need to make sure that it's going to even out over time. Be your own bank, have your own ownership, etc. Decide upon yourself and not be dependent on one guy making certain decisions.
Maybe I would add on this, like there's a slightly different spin perhaps looking at Bitcoin-backed lending. I mean, not necessarily being your own treasury company. The way we look at it is through the lenses of so-called asset-backed living, right? So assets, good assets, you never sell good assets, right? Just like you don't want to get rid of your Bitcoin, it's the same basically principles apply to traditional finance, right? So for example, and normally this was a domain for rich people, for high net worth individuals and all that. My favorite example is, Elon Musk, when he was buying Twitter, he didn't buy it for 40 billion in cash or whatever the price tag was. He actually used his Tesla shares as a collateral. He got a loan at very cheap level and funded the purchase of Twitter. So this used to be a domain of really high net worth individuals or basically institutions using assets as a collateral. And this is what I love about Bitcoin-backed lending, and that's why we call it Bitcoin-backed living, that you can actually, these strategies are now accessible to any Bitcoiner out there, right? So if you have a little stack, you can already start using the same techniques and strategies as institutions or high net worth individuals.
And I think also talking about that, like what DICE is that, I think everyone here agreed that Bitcoin is the best collateral in the world. We are working mainly with institutional investors, and it takes a lot of effort to explain them why Bitcoin is the best collateral in the world and why they should invest in Bitcoin-backed lending. I think the dynamic are changing. We see more traditional investors that they're realizing that they understand the risk around the custody of the collateral, how they can mitigate this risk, and that Bitcoin is a very interesting collateral. They can liquidate it at any time. They can liquidate even large amounts, even during night. So I think this understanding of Bitcoin as collateral is really shifting the way that institutional investors are seeing, and also allow then borrowers access to cheaper credit. I think the most important.
Yeah, and maybe on the liquidation side, so there's always this very negative tone around liquidation, but when you think about it, like again, you should prevent it at any time, of course, because there's tax impact, etc. But what it basically is, if you didn't take a loan, and you wouldn't have sold either the Bitcoin at the point that you take the loan, and then at the moment you get liquidated, it's basically you're forced selling your collateral. So if you didn't take a loan, if you just hold on the same write down and you needed cash at that moment, it is exactly the same, other than maybe some liquidation fee. So yes, it's not ideal, but it's not like it's very bad. If you are able to free up the cash somewhere else, like the loan, for example, you have outstanding, and you're able to free that up and buy back the Bitcoin at that same moment, you wouldn't have made any losses in terms of Bitcoin. So there's this very negative tone, like you're leveraging like you are doing on derivative markets, but that's not the case. I mean, you're just taking a forced sell, and if you have the loan still available somewhere else, like, I don't know, in a term deposit or something, you free it up and you buy back the Bitcoin. You might even, if it goes a little bit lower, you might be able to optimize your stack there.
Okay, I'm listening to all of you, and I recognize that everything you're saying makes a lot of sense, but because I've been there, and I've been having these thoughts, meanwhile, I was operating in both sides of the equation. No? So maybe I want to ask you, of course, you are all operating on loans, but why should a Bitcoiner that just stacks ads and never thought about it, why should consider taking a loan? Because taking a loan means that you put Bitcoin as collateral, you get fiat in the form of bank fiat or stablecoin, but then you have an interest to pay. And
Yes.
normally, if you compare with people, is used to think about interest in mortgages, no? And compared to interest of mortgages, they are higher. So why should I be in debt? If I read a lot of Bitcoin books and debt is evil, why should I go back repeating mistakes? So how could we change that mindset, or what would you say to them?
I think it's important to understand good debt and bad debt, right? There's unsecured debt, which you might need to meet cash flow needs. That might be bad debt for you, depending on the rates there. Bitcoin-backed lending rates have come down significantly. I think 2 years ago, you were lending at like 13, 14%. Today, we started our loans at 6.5%. Mortgages, at least in the US, and I don't know what the rates are here, but at least in the US, mortgages for prime lenders are in the 5 to 6% range. Except that's an amortizing loan, which means you're paying interest and principal every month. In all of our lending structures, you only pay interest and then you pay principal whenever you mature the loan, which could be years from now. You can keep rolling that loan as well. Bitcoin's CAGR, the compound annual growth rate, is much higher typically than the interest rate that you're paying. So the asset is appreciating much faster than the interest rate that you're paying. As a result, you're always going to be net positive in a long-term perspective. Now, there are times when things go down and you have liquidation risk, you have margin call risk, of course. And I think as a lender, it's important to understand people's individual use cases and give them discretion as much as we can on those margin calls, help them meet the margin call if there needs to be. But I don't think understanding debt as a bad thing is really the right approach here, because as we spoke about just in the last question, when you build significant assets in the traditional world, right? You have stocks, bonds, real estate, whatever. What do? You go to a private bank like UBS or JP Morgan or wherever else, and you onboard. You say, these are all my assets. I'm never going to sell for the rest of my life. I'm just going to borrow against it. When you sell, you lock in a taxable event, and you lose out on the upside. So if you want to use your Bitcoin for something, then you have to be able to leverage it, right? Unless you don't want, if you just are sitting on your Bitcoin, you could dig it up in your backyard, put your wallet in the ground, and come back to it 10 years later, and you've not done anything with it. If you actually want to use it, you have to leverage it. And there's some people who like to spend in Bitcoin. That's not our opinion. I don't think you should spend in it. I think you should hold on to it for life as a reserve asset and spend against it. Because your dollar is depreciating 7% a year. Most other currencies are as well. Bitcoin appreciates on the other hand.
But maybe as we're still early to Bitcoin, like one of the things is that, like I mean, early to Bitcoin, even earlier to Bitcoin-backed loans, we need to harmonize more and more on the standards and making sure that, you know, how do margin calls work? When do they trigger? Are we able to increase the loan-to-value ratios over time? Because the companies providing the Bitcoin-backed loans are more comfortable with, you know, doing these processes. And as long as we start to continue to harmonize these strategies and applying this, we are able to get better ratings on the market. We're able to get cheaper capital, and cheaper capital in the end will always reduce the risk of the borrower. So, sort of like working together, also challenging each other, will further harmonize this market.
And I think it's also important to keep in mind as a borrower, what's your timeline, right? So if you have a thesis that Bitcoin is going to you know, outperform your debt in, let's say, 4 years, it's too risky then to take a loan of 1 year. So you need to be either able to extend it at maturity or find a way to repay it and then open a new one. And again, I think it's very different to take a debt with your credit card at 18 APR to buy a new fancy TV, than actually take a loan against your Bitcoin for, let's say, 5-10 years, knowing that the value of the assets today is going to be worth 10x in 10 years. So that's the thing. It's
and I mean, you're in control. Like,
you're in control, yeah.
Exactly. Like, it depends on you. If there's a maximum of, I don't know, 70% initial loan to value. So let's say you post 100,000 euros worth of Bitcoin and you borrow 70,000 with the risk of liquidation being very close. It's very different than borrowing 10,000 euros against 100,000 euros worth of Bitcoin as collateral. So you are in control. You can usually repay the loans, or you're in control of managing this risk. And you should always be on the lowest side as possible. And it depends on the custody setup and how comfortable you are, but make sure that you understand the market. If Bitcoin is going to go up to 250,000 euros, yeah, I wouldn't take a maximum loan, especially if it goes very rapidly up. You are a little bit responsible there.
Mm-hmm.
And I think there are ways to avoid the liquidation risk as well. We've seen a few lenders, including us, launch non-liquidating loans. And there's ways to use options hedging to enable that, where you actually don't have to worry about liquidations. You do have certain price bands in which you have to operate. But if you've done that smartly and the lender helps you figure that out, you really can completely avoid the liquidation risk.
I would just add one thing to your point, Luna, like whether that is bad, right? I think it's important to distinguish between debt and credit, right? Because even though it sounds kind of similar, is having a credit card a bad thing? Is having a mortgage a bad thing, right? So it's basically just debt or credit. It's just a strategy of how to get the notional or the monetary value out of your asset, right? So as gentlemen were saying, like definitely you need to be aware of all the risks, right? Liquidation risk, custodial risks. We've seen in the past, and especially in Bitcoin lending, there's been a lot of negative talks around these strategies because of the collapses of Celsius, BlockFi, and so forth, right? So before you jump on the wagon, definitely, again, as I said, like do your research, try to understand what are the inherent risks, but ultimately taking a debt against an asset that appreciates over time, as Paolo mentioned, if you have the thesis that Bitcoin will grow in the future, why selling it, right? So rather use these strategies that are battle tested. There are definitely great options in the market, so I wouldn't be that scared of leveraging these strategies.
And just to add here, something I realized speaking and teaching about lending to people is that it's not like a loan as you are used to in the bank. Because in the bank, you ask a loan because you don't have the money and maybe you don't have the asset.
Yes.
So your collateral is your salary, in 10 years, for example, no? So you become a slave of that debt, because if you don't pay, they will come for you. But in in Bitcoin-backed loans, that is a debt, but it's kind of already paid if you don't want to pay it back. So nobody will come for you. Even sometimes you can ask non-KYC. So it's like they don't know who you are. So it's because it's a kind of a different debt. So maybe it's a debt, yeah, it is, but it's different.
And there's no credit checks, which is also an important one.
Yeah.
Yeah. Before you touch on a point, Igor, which is interesting, because a lot of people, when they hear about Bitcoin-backed loans, they say, okay, how much percentage am I going to earn on my Bitcoin? And it's like, it's not like that. You know, you can earn on fiat, and you can borrow against your Bitcoin. But earning yield on Bitcoin is a complicated thing, and it could be the topic of another panel. But yeah, I want to touch now on the other side of the equation, because for me, lending is kind of a breach of liquidity, a breach between two walls that are separate. And there is an actor on the other side of the bridge. That is the fiater, you could say, no? Somebody having fiat. Could that, because of course, it's if you have liquidity in fiat, then it makes sense. You can get very nice APR, very nice interest. Yeah, makes sense. But could that other side of the bridge be interesting for a Bitcoiner somehow?
The problem of Bitcoiners is that normally they don't have fiat, right? But of course, I mean, I think if you have like part of your wealth in fiat and you want to generate a yield on it, at the moment the market offer like extremely interesting opportunity. You just need to be aware of the lockup period. So normally when you lend fiat, you lend it for months, few years, depending on the conditions. So if you suddenly need to access to that liquidity in 1 month's time, then that doesn't work. But yes, I think it's a great opportunity. As I said, unfortunately, well, luckily for us, we normally Bitcoiners, they don't have a lot of fiat to lend, and that's why we as a lender, our clients are not Bitcoiners. Our clients are traditional investors that they lend into credit products. They don't care about the volatility or the upside of Bitcoin. They just want to make sure that from an operational perspective, their risk is mitigated, that the collateral of the custody is safe, that there are safe mechanisms to have fully automated margin call liquidation. So even in the case of high volatility on the market, their investment is protected. And the good thing is that at least what we see in the market, the mindset is really changing. So we see a lot of traditional investors coming in. They understand the products, and that's I would say that the main impact is that allow us to borrow at a cheaper rate.
Okay.
I think,
Yeah, I'm sorry.
just to add to that, if you're an individual today and you want to earn yield on your fiat, we already have very simple products for that. Michael Saylor was here yesterday speaking about Stretch, and if you want to earn a very safe, liquid 11.5% on your fiat, you can just go buy Stretch, or 13% to buy SATA from Strive. There are some European treasuries working on similar products here as well, which I'm sure will be out in the next few months. These are non-locked up, publicly traded securities that you can just go put your fiat in, and you earn your yield very simply every month. So you don't have to complicate things. We are already enabling this in public markets. It is a form of Bitcoin-backed credit, and you can just go buy that on any stock exchange.
But isn't the risk profile much different there compared to a over-collateralized Bitcoin backed loan?
Absolutely. So there's also methods to improve that. So I think a lot of us listened to Saylor yesterday. I had the chance to have a dinner with him and discuss this as well, where we talked about digital credit and digital money. Digital credit is a product like Stretch or SATA, and digital money is a smoothed out product on top of that, like Apex or Saturn, where you have a mix of treasuries and some other more stable, low volatility assets combined with something like Stretch or SATA, where you can actually reduce the volatility curve while still maintaining a yield. and maybe it's not 11.5, it's 10%, but it's a safe 10% in a these are on-chain products, but there are approaches now in building this in a securitized rated fashion as well, where a ratings agency is actually saying that we rate this as a AA or a AAA, and you can then very comfortably go on a safe yield on that.
Yeah, maybe to come back to your question. So how I see it is more from the other way around. It's secured lending, as we call this proposition. So providing capital for Bitcoin-backed loans is actually one of the neatest way into Bitcoin adoption, because traditional finance is looking for euro yield, and with us, there, like for the longer term, you can gain up to 7% interest on your euros. But if you want to get that, I mean, you're forced to investigate, do your own research, and how does it work? And then it's a initial 200% over collateralized loan. Oh yeah, that's interesting. So I can verify the collateral, and this is how it works. And it's the same in Firefish. So actually, and it happens all in the same platform where they can also, I mean, in our case, buy Bitcoin. So they get interest payments. Maybe I'll just use that to buy some Bitcoin. So it's actual a way of getting traditional finance into the Bitcoin space, adopting Bitcoin, and maybe that will just cascade. And in the meantime, we can build better like rated products and lower the cash position there.
It is a way of stacking sats with fiat, but not buying directly with that fiat, but using that fiat to generate a cash flow that will keep on buying sats in a different amount, of course, but for a longer period.
Well, I mean, for us, for example, we're in a very specific situation because, I mean, our platform is a peer-to-peer marketplace, right? So we are actually connecting borrowers with lenders. And the interesting point was when we launched the platform at the very beginning, we were kind of a little concerned about like where's the liquidity going to be coming from, right? Because you come to the market, you're like, hey, I've built this non-custodial Bitcoin bank lending platform. You come to a bank, they'll be looking at you like, what's this Firefish protocol and these kind of things, on-chain transactions and stuff like that. So at the very beginning, the surprising fact was that the lenders, vast majority of the lenders that were on the platform were Bitcoiners, right? So Bitcoiners who, because we're still living in fiat economies, everybody has some income, some savings and all that. So instead of keeping your fiat or stable coins in a bank, earning 0.5% on euros or whatever, a lot of these Bitcoiners understood that this is actually much better way of not even generating the yield, but rather protecting themselves from the inflation, right? From the fiat inflation. So if the yield on your fiat or when you're funding Bitcoin-backed loans is higher than the inflation, you're sort of protecting your stack, right? But with time, then we've seen as the platform was getting traction, we had more and more retail or traditional investors coming to the platform. To a point, and to your point, Luna, that this is also actually a way of helping with Bitcoin adoption, right? So there are many people who are not Bitcoiners on the platform that are funding these loans, and Bitcoin is actually helpful for them, right? They are actually indirectly leveraging Bitcoin as a collateral, as a security against their sort of investment into Bitcoin-backed loans, right? So this is also an interesting point. And the other point is that, as we've mentioned, the interest rates have been really going down. And why is that? It's really because there's more and more liquidity in the market. More and more people do understand the whole concept. So Bitcoin-backed loans are really becoming almost a standard investment vehicle, if you put it this way. And that's why the rates are going down, which is really great for, I mean, maybe not as great for the investors because their yields are dropping, yet still they're significantly higher than many money market instruments, let's say, out there, and especially considering the risk profile, right? Bitcoin bank loans over-collateralize, automated liquidations, right? So the risk profile of these instruments is much better than any other asset in any other asset class, basically, that is offering similar yield, right? So if you invest, or if you want to find an alternative that gives you, I don't know, 7-8% in the market, apart from maybe Stretch and so forth, you would have to go towards, let's say, junk bonds, or some unsecured securities and things like that. Bitcoin bank loans have a beautiful risk yield profile, and that's why they're so helpful.
Yeah.
And similar to the borrower, I think lenders should be aware of the risk, right? I mean, just make sure that you're lending to platforms that is similar to Firefish, Blockrise, that they are properly handling the collateral. So just do your own research and understand the risk.
Not financial advice.
Yeah.
Not financial advice.
No, but everything is relative as well. Like I was talking to one of my employees who used to work in private banking, like in the banking space, and he was saying over dinner yesterday that yeah, there were loans of like 80 million that were provided by the bank that turned out to be non-existent. Like the collateral didn't exist because it was like some physical things. And that's the crazy thing with secured lending in Bitcoin is you can always verify the Bitcoin on chain. You can do message signing, you can verify the proof, you can verify the ownership. So yes, of course, there's risks, but it's such a pristine collateral that it's crazy that we can build things on top, and we're just getting started.
Yeah. I want to ask you a personal question that is in my interest, because when I started, I started, and as a beginner, I was a nobody in this market, and I was using my own capital. And the first year, I got close to 20% APR average, 2024. And I was like, okay, I understand the black magic behind this, and I feel so secure with this. And yeah, I know that we're in bull market, so I kind of understand the FOMO and why people is paying this. Okay, I enjoy that. And I see that this now we're going down, and Igor is saying that maybe it's due to liquidity. Is due to liquidity, or is due to market conditions? Do you think that when bull market will come back, we will see a raise in interest rates of Bitcoin-backed loans, or this is something that was in the past and this kind of interest will hold now?
I don't think rates are going up. This is not me hoping. I frankly don't think they're going to go up from here. And the reason is the people providing liquidity, that profile has completely changed. In the past, you had platforms like BlockFi that just matched retail deposits with lending, and you had duration mismatches and such. Today, the investor profile across different products over here is very institutional. We have lines from a bank. We have other like long-term credit facilities. The hurdle rates there are very different from what an individual wants to earn on a small amount of their stack, right, or of their cash. So that's not going back. I think people have also understood the collateral profile of Bitcoin, and as a lender, you're looking for a safe zero loss product. This is the safest zero loss product, and I think as these facilities get securitized in public markets, sorry, in money market funds and in other assets there, we'll see the rates come down even more, closer to the
Bank rates?
the federal funding rate,
Federal.
which I'm not sure what's called in Europe, but in the US we call the secured overnight funding rate. And I think as we get closer to that, in times of a bull market, we'll see even more borrowing demand, which means that there'll be even more capital required. So yes, you might see small increases by basis points, but we're not going back to 20% for sure.
Yeah, and keep in mind that track record is very important as well. Like every day that we basically are in this space, the standardization is optimized and track record is there, so it becomes more trusted. And second, like we're very deeply focusing on Bitcoin-backed loans here, but in the end, it's the entire ecosystem what we're building on. Custody gets better, trading gets better, and this is all components that you need in order to provide Bitcoin-backed loans. So as we keep building and all the companies around Bitcoin keep building, it just becomes better. If people understand it better, institutions can get better access. They can see the collateral easier, you know, those kind of things. It becomes less of a cypherpunk space and becomes more of a, yeah, not traditional space, but that direction.
Money markets in general.
Yeah.
Yeah.
And I mean, we see like, I mean, the beauty of Bitcoin-backed loans is that as a borrower, you really have a variety of options, right? You can go into like, you know, full self-custody mode, relying on a solution like Firefish, or like regulated approach, like you guys. You know, for instance, like in Switzerland, we see now traditional banks, like state-owned banks, that are starting to offer to their clients credit against Bitcoin. So it really offer like a solution for every type of borrowers. You know, from the individuals that want to use like you know, his hardware wallet and wants to have like full transparency on the custody, to the institutional or the treasury borrowers that wants to use more like a regulated counterparty.
We're running out of time, and it's a shame because I had like a few more topics to touch. But I will open one last one, and maybe you can put your opinion on that. And it's KYC. People that know me, I try to still play the non-KYC in everything I do. and non giving away my custody, so I'm still holding. A good word. So I'm afraid of KYC in general, and I'm afraid not because I hate it, but just because, for example, what was happening in France this year with kidnaps, with information being leaked, not because you guys do it wrong, even because maybe institutions you provide the information do things wrong, and some functionary is then selling the information out and so on. So with this kind of leaks, are your customers worried? And how do you manage those fears in this kind of market?
Frankly, I don't think we've seen our customers worry about this. We don't sell your data to anyone. We also don't report your KYC information to anyone. It sits secure. It's not even on our servers. It sits with a regulated provider called Persona. There's obviously different schools of thought around KYC, and people use a mix of self-custody and qualified custody, at least with a platform like ours, where in order to get the benefits of bankruptcy remote treatment for your collateral, in order to get the insurance, in order to get the rates that we're able to provide and the service we're able to provide, you have to onboard onto the system. Now, addressing your point about what happened in France, who was one of the people that got kidnapped? It was the CEO of Ledger, which is a non-KYC platform, right? So I think your physical security is only as strong as who knows you. And I think it does somewhat relate to KYC, but it's more about if you're out there in the open talking about how much you have, you're on Twitter talking about how much you have, maybe there it probably makes sense for you to be a non-doxed individual. But I don't think it really relates to the risk in the lending market specifically. I don't think any of us are selling data to anyone, and if we were, I think that would be a totally different conversation.
Yeah, I wouldn't even talk about selling the data, right? So if you're a KYC platform, you just have to use a provider that is, doing the checks and all that. So are there risks, that this data might leak due to, I don't know, technology, due to some, bad actor inside of the provider? Potentially, yes, right? Ultimately, unfortunately, this is something that we need to accept as a fact. You want to do business in Europe, basically, and you want to attract traditional finance institutions into your platform, you will have to do the KYC, right? There are non-KYC options, definitely, but I think these platforms will always be struggling with liquidity in particular, right? If you come to a bank and say, like, hey, open a credit line for Bitcoin-backed loans, they'll be asking, okay, so who are the counterparties? Are you checking on them and all that? So if you say no, then they will not give you the credit line, or you'll be paying double-digit basically figures, right? So it is a trade-off. Do I personally like KYC? Not that much. What we also see that different countries have different mindsets when it comes to KYC. I would say Western Europe is kind of very happy KYC. The more you go to the east or LATAM, as you know, KYC is almost an enemy. So yeah, it really depends, but it is something we need to accept.
Yeah, we have 50 seconds. So what to say?
Yeah, no, maybe very briefly is I think that we Bitcoin companies, we need to care as much as we can on this. So we need to be flexible. We need to be understanding the clients and minimize the knowledge. Like data, you cannot undo data. So just like, yes, we need to be regulatory compliant, but minimize it and understand the client and respect the Bitcoin vision there.
Paolo?
Yeah, same. I mean, unfortunately, we are dealing with institutional clients, so for us, KYC is part of our mandate. But as Jos said, we try to minimize as much as possible the information that we collect.
We even have 9 seconds left. It's amazing. So thank you, guys. It was an amazing conversation. I would have loved to have 20 minutes more. So that means that, yeah, it was a good one. Thank you.
Thank you.
Thank you.